This video reviews Lecture 1, Financial Goals and Personal Finance Basics. The materials adapted from Eric Townsend's book, Personal Finance for Dummies, 8th edition, as well as the article by Rooij, Lusardi, Alessie at 2011 Financial Literacy and Stock Market Participation. Personal finance basics includes how to concretize your financial goals and set up a plan to get there, how to spend and save wisely, how to invest smartly, how to put in place measures to protect your family against catastrophes in finance, and lastly, how to get yourself a chance of a home run. First, I want to define the terms from the lens of personal finance. How would you define your financial goals? Based on debt, assets, net worth, passive cash flows, or others? How do you define education, job, career, retirement, being rich versus being poor? Here, I want to share the definitions of my thoughts from the lens of personal finance for those common terms. First, I want to encourage you to think about what should be your definition and perspective. Don't follow the crowd. Don't let the others to define your financial world. Instead, look for your heroes, someone you aspire to be like in the future, and see how they define those terms. Then you want to form your own definitions and implement those definitions so that you can be like your heroes in the foreseeable future. So hopefully, I hope you continue to search for your definition till the semester ends. From the lens of personal finance, we can redefine all of the terms. First, let's start with financial goals. We may consider financial goals in 3 different layers. Number 1, financial goal can be financial peace, meaning that you don't worry about repaying your debts. You don't worry about maintaining a minimal lifestyle. The second layer of financial goal is financial security. At this stage, you don't worry about maintaining your basic lifestyles and achieving basic financial goals such as retirement, education, and health, and basic lifestyle. The last and ultimate financial goal can be described as financial freedom. During this stage, you don't worry about money anymore. You no longer work for money. So you should concretize your financial goals based on the 3 different layers of financial goals so that you would set a plan to get there. To achieve each goal, in this course, we will teach you how to behave rationally as behaviorally optimal, but not necessarily be the rational maximizer. So we'll try to get there with the least, from the least resistance way. Specifically, what is education? From personal finance, education can be defined as investment in your human capital so that you can earn higher dividends, which is your labor income, on your human assets in the near future. Therefore, to make this investment efficient, you want to strive your cost of education to be reasonable, to be cost efficient, and to have a good expected return. How do we define job? From the lens of personal finance, job is the type of work you do to reduce your cost of education, to increase your investment in your human capital, and to allow you to survive for now. Therefore, you want to get a job that serves multiple purposes of the above in order to increase its benefits. Job is not something you are going to have forever, because eventually we want you to move to your career path. the type of work that will make you excited every morning, looking forward to the busy and productive day. Through this long-term hard work in your career, you will be able to achieve bigger goals that include but go beyond financial freedom. Therefore, what you want to do is to shift from job to career as fast as you can, because that's something, career is something you are going to invest for your lifetime. Then what is retire? Retire is not when you stop working. Retire is the day you achieve financial freedom, when you start to live to enjoy your work and life without worrying about money. The day you start to work not for money, and not the day you stop working. So financial freedom is the beginning of a new work life, not the end of work. So what is being rich? In personal finance, being rich means that you have more income than your expenditure, you have more assets than your debt. And when you are financially free, your passive income will be more than your non-discretionary spending. You can sustain your basic lifestyle, so you don't work for money at that point. In contrast, being poor means that you have income less than your expenditure, you have assets less than your debts. Your passive income is not enough to offset your non-discretionary spending, so you have to continue working for money. Okay. So hopefully those new definitions of those common words will give you some thoughts about how to define your terms in your financial world, so that you can perceive and assess everything discussed here from the lens of personal finance and make an optimal and rational decision. So the useful mindset to deal with personal finance, I would argue that personal finance is 85% personal and 15% finance. Here, personal meaning the personal behavior. So your behavior is more important than the knowledge of finance, and you don't need to know fancy knowledge about finance. You need to know the basics, but you have to have developed a set of good behavior to stick to your plan in order to achieve your financial goals. So you want to have a new mindset to look at and treat your money. So money is like your pet that needs good care. If you don't care about your money will not care about you. You want to concretize your financial goals so that you can set a plan to get there, instead of thinking it's still far into the future. You want to have an actionable plan that is composed of your income, spending, saving, debt, assets, and cash flows in order to get higher net worth, higher passive income. From behavior finance perspective, money is impartial, money is unbiased. Money doesn't judge people based on color, race, origin, political party, age, and gender, and degree. So money will treat you back at the way you treat your money. If you treat money as you love the pets and children, it will love you back. If you don't care about your money, it won't care about you. If you defer the problem with your money, it will come back to you with a consequence in the future. And if you don't have a plan with the money and execute the plan, you will never achieve your financial freedom and financial goals. The dimensions of personal finance includes the management of income statement, cash flow statement, and balance sheet, like a corporation. Here we provide the financial literacy test, because the higher financial literacy you have, study shows that the more likely you deal with your personal finance successfully, the more likely you can increase your net worth. Financial literacy score provided in the quiz includes 16 questions. You can see that it has 5 questions for basic financial literacy and 11 questions for advanced stock market literacy. The research shows that university degree is positively related to financial literacy. For the basic financial literacy, university degree graduates, 70% of them lies in the highest quartile in the population. Here we use the Finland population as an example. Financial literacy score tends to go up with your age and peaked around age of 50 and gradually decline due to the declining cognitive ability. So there's a trade-off between experiences and cognitive ability. Therefore, to maintain your financial literacy and your financial sophistication, you want to keep learning to combat the decline of cognitive ability when you age. The study also shows that male participants have higher financial literacy than female participants. Most importantly, advanced stock market literacy. The scores from the last 11 questions are most important for stock market participation. So the higher the advanced stock market literacy score, the more likely the individual participating in the stock market earning equity premium, because stocks are shown to have higher returns than bonds and many other financial asset classes. Therefore, to increase your net worth, one wants to participate in the stock market. Controlling for the advanced stock market literacy index, the basic financial literacy index is no longer important for stock market participation. So let's move to the management of the 3 statements in personal finance. For income statements, here we want to focus on the source of income. Most people, when they're young, they only have single source of income, which is dividend. That's considered to be dividend yield on your human capital. When you are investing your education, you are doing the investment on your human capital. Over time, however, one wants to broaden the source of the income for the individual and the family. For instance, over time, you want to develop your income sources from investments, financial investments. It could be investment in real assets or financial assets, and the dividend yielded on those assets becomes your financial or your investment income. You also want to, if possible, to develop your business income. Businesses can be considered as combinations of human and real assets. So the dividend yielded on this business is your business income. So if you can diversify your source of income, it will drastically improve your outlook of personal finance and increase in your net worth. The second statement is the cash flow statement. It's similar to the income statement, but it counts for the timing of the cash flows. And here we have cash flow in, which is from income. We have cash flow out, which is the spending, and also the interest paid on debt. The difference between income versus spending and debt servicing is our savings. Okay. So in order to manage your cash flow statement well, you really want to increase your savings as much as you can by increase your income and broaden the source of income at the same time, reduce your spending and reduce your debt burden. Okay, so you want to save more in order to turn the savings into assets that generate future income for your family. Many people have problems with spending. So the advice on controlling your spending is to keep a home budgeting worksheet to track the expenses. Try to lower the fixed cost if you can. Don't make spending into an lifestyle, but make it into an experience that you enjoy from time to time, but not every day. And also, to increase your savings, you want to determine how much you can save each month before you determine how much you can spend. And you want to make your savings automatic. You want to treat savings as paying yourself in the future. You also want to specify your goals for each savings. The savings can be used to pay off debt, can be used to save for down payments for big purchases in the future, and most importantly, to acquire assets that generate incomes in the future. The last statement is the balance sheet. Like a corporation, a personal finance balance sheet includes assets to the left-hand side and debt at the bottom, net worth to the right-hand side instead of equity. Net worth here is assets minus debt. So your assets can include human assets, business assets, real assets, and financial assets. Okay, so here later we're going to talk about how to increase your assets to generate income. But now let's first deal with the debts. Okay, so there are many forms of debts. And first we want to distinguish good versus bad debts. Bad debt here is defined as debt that are not expected to generate future incomes for the debtor. Because of that, you want to minimize or totally avoid the bad debt. The bad debt includes, but not limited to, for instance, credit card debt, which is unsecured consumer debt accessed through credit card. It can include car loan. It's the loan that borrowed using the car title as collateral. And payday loan, which is the money lent at a much higher interest rate, and it will be repaid when the borrower receives the next paycheck. Okay, sometimes car loan is necessary because you need a car to get work to get your income. However, if you borrow money to purchase a car, try to minimize your cost and try to not to have too big a loan relative to the income you can generate. It helps you to generate. In contrast, we could have some good debt. The debt that can be good, but not always be good. For instance, so our criteria to judge whether the debt is a good debt is based on whether the debt can generate future income exceeding the cost of the debt. If so, you want to strive for affordability and cost efficiency. Such debt may include student loan. It's the loan that you use to invest in your human capital in order to generate higher labor income in the future. However, excessive student loan can burden you in the long term and jeopardize your cash flow in the future. And it cannot be usually discharged in bankruptcy. Mortgage can be good loan because it's the loan to fund a purchase real estate property with the title of the property as the collateral. If mortgage allows to save on your rent, and also you may also rent out part of your property to generate income that's exceeding the cost of the mortgage, then you are making a good debt. You are having a good debt. However, if you borrow too much mortgage, buy too much house relative to your income, and it may not be a good debt. Lastly, home equity line of credit is the loan borrowed against one's home equity. It may be good debt depending on the use of the debt. Some people borrow home equity line of credit to fund their education, to fund their business, and so on and so forth. If the loan helps you to generate future income exceeding the cost of the loan, it can be treated as good debt, otherwise it's not. If you are burdened with too much debt, your income is not enough to service for debt, you may fall into bankruptcy, personal bankruptcy. There are two different chapters for personal bankruptcy. Chapter 13 allows you to reorganize your debts and enter into a repayment plan to pay back all a portion of the debt. It prevents most creditors from trying to collect on your debts, but student loans are not typically discharged in Chapter 13 repayment plan. Chapter 7 is the ultimate bankruptcy. It's the liquidation of all your assets to pay off your debt, and also student. Then you enter automatic stage, and student loans are not automatic discharge unless there is a proof of undue hardship. So Chapter 7 is really painful to go through, but it allows you to fully discharge your debt, excluding maybe student loans. In any chance, I don't want any of you go there. So you want to have a good management of your debt, increase your income, diversify the source of income in order to avoid any chances of bankruptcy. In personal finance, the key to accumulate wealth is you first want to invest in your human capital, earn labor income. Then you want to save as much as you can and convert those savings into investing in real assets, business assets, and financial assets. By increasing your financial assets, increasing your balance sheet. The balance sheet will grow to accumulate income-generating assets. Then you end up having a lot of assets as your employees to generate passive income for you in the future. So when your passive income generated from those assets can maintain your basic lifestyle, then you achieve financial freedom. Then how much do you need to have in order to retire? Meaning in order to not to worry about money, not work for money. I would say this depends on your financial goal and economic environment at the time of the investing retirement. So you have to look at the replacement rate of the retirement income relative to your salary at the retirement before retire. You want to look at your source of other income in addition to your savings in the retirement account, such as Social Security, rental property income, business interest and dividend, and etc. You want to look at the expenditure you expect to have in your retirement life and the expected return on your nest egg, which is your retirement savings portfolio. And so this answer may vary substantially across individuals, across countries, based on the cost of living, across retirement age, and more. Many personal finance experts would advocate the SAFE rule, which is the 4% rule, meaning that you want to save 25 times of your annual expenditure and withdraw no more than 4% per year from your retirement savings that would play safe and to ensure that you won't run out of money for a long time, if not indefinitely. So this say 4% refers to the safe withdrawal rate. Recently, some of the financial bloggers advocate a much lower safe withdrawing rate, such as the 0.5% rule. Those are the extreme views. However, they reflect the concerns for retirement savings in the ultra-low interest rate environment. So I encourage you to look at the link to check out those articles. The rule of thumb we also propose for each individual family is to save at least 15 to 20% of your income annually in your retirement accounts. For the average savers, you can consider 15 to 20% of your disposable income, which is after income taxes. For aggressive savers, you can try to save 15 to 20% of your gross income, which includes the pre-tax money. Okay, again, the savings rate can vary based on your financial goals, your lifestyle, the expected return, life expectancy, and so on. In one of the links I provided, the Blackboard, it provides has an article, provides the table that shows you the variations of the required savings rate in order to generate a retirement savings, retirement account that's enough to last for the retirement phase. As you can see that the longer you expect the portfolio to last in the retirement phase, the more you have to save. The shorter the period in the accumulating phase, the savings phase, the more you have to save. The more aggressive of the asset. In addition, the more you allocate your portfolio into risky assets such as stocks, the less you need to save, but the more you allocate your retirement portfolio to safer stocks, the more you need to save. As you can see that the savings rate can range from anywhere 6 to 10% to 50 to 60%. So the answer really varies a whole lot across individuals. Now let's look at the downside protection in personal finance. As a family or an individual, what kind of insurances or measures you have to put in place in order to protect yourself and your family from catastrophe shocks in finance? So you want to protect yourself, your family, your loved one, as well as your assets. For yourself, you need to protect your ability to work. Basically, the health of your human assets, the safe and soundness of your human assets. You want to purchase health insurance to cover catastrophe scenarios with advanced illness, emergency room, etc. For your information, your coverage in health insurance, you can stay with your parents' policy until you secure full-time employment if you can. And also COBRA allows you to stay on your parents' policy for up to 18 months after losing coverage. Self-employed individuals, you need to get your own policy with a high deductible. In that case, make sure you use a health savings account, HSA account, to fund your deductible tax-free. And there's a lot of benefits with that HSA account I want you to check out on various bloggers. Number 2, you also want to consider purchasing life insurance. This is protect your loved one when you lose your ability to work. Number 1, purchase long-term disability insurance because ensure you the complete loss of ability to work or take care of yourself. You also want to purchase term life insurance, ensure the scenario that you for your dependents when you lose complete ability to work. Okay, it covers the cost for your dependents in terms of their mortgage, child rearing ahead, and the spouse, and so on and so forth. Okay. You also want to protect your assets. To protect your real assets, such as car, you want to purchase car insurance, which includes the personal property and liability protection. Should a lawsuit arises of something that happens to the car. If you have a home, you want to purchase home insurance. A home insurance policy ensures the personal property and liability protection shall lawsuit arise out of something happens at the property. It may include the dwelling coverage, cover covering the cost of rebuilding the home in your area. It also includes the personal property protection, which recovers the contents in your home. If you have a rental property, purchase a rental insurance. It gives you the personal property coverage and liability protection. If you have savings in a banking account, FDIC insurance covers the loss of your savings up to $250,000. If you have an investment account, each account, if it is insured by SIPC, each account is insured up to $500,000. If you have more than that, make sure you spread your money across different accounts, across different investment companies or banks to keep your money safe and sound. Lastly, to protect your loved ones and your assets, you want to put in place the last will and testament. This helps to make sure all the things you leave behind gets taken care of according to your wishes. And it also helps your family to lower the cost of legal cost to transfer your estate. You want to put in place a financial power attorney, which gives permission to someone you trust to handle your important financial and legal matters. You want to put in place a healthcare power attorney, which appoints someone you trust to make the healthcare decisions you'd made if you become incapacitated. Sometimes some family have a living trust to preserve their estate for their loved one by controlling their assets during their life. This helps to save the court and legal cost. Okay. And you can go to many websites instead of having a in-person visit with an attorney. You can have all of those documents done very quickly online nowadays. What are the common mistakes young adults tend to make in terms of personal finance? Number one, people tend to spend too much, accumulate too much consumer debt, which are considered to be bad debt. Number two, young adults may default under student loans or other debt, which lower their credit score and cause damage to their future ability to borrow even good debt. Number three, young adults may experience failed relationship that would cause damage to their credit, rating, and financial health. They may also fall behind of tax payment, violate tax laws, and cause a lot of trouble. And making poor investments, neglecting to secure the property insurance coverage, get themselves into trouble. And also being taken advantage of by people who gave biased advice. All of those can be avoided and minimized through your diligent learning about personal finance and stay on top of your money and knowing to make informed personal finance decisions. So the keys to personal financial success provided by the book of Personal Finance for Dummies includes the following. Try not to buy consumer items that would lose value over time on credit. Use your credit card only for convenience, not to carry the debt because the interest rate is too high. Live within your means. Don't try to compare yourself with your friends and coworkers and neighbors and peers. And save and invest at least 15 to 20% of your income. Take charge of finances. Hire yourself first if you can do your tax return, tax accounting, investment yourself, and do it yourself. Nobody would care about your money than yourself. Invest in yourself and your relationships by saving for retirement, by finding the good partner that also cares about money. And try to be successful in managing income, cash flow, and balance sheets in personal finance.